to the Carborundum Universal Q2FY26 earnings conference call hosted by Kotak Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and 0 on a touch-tone phone. Please note, this conference is being recorded. I now hand over the conference over to Aditya Mongia. Thank you, and over to you, sir.
Thanks, Mark, and good morning, everyone. Welcome to the earnings con call of Carborundum Universal. From the management side, today we have Mr. Sridharan Rangarajan, Managing Director, and Mr. D. Chandramouli, Advisor. Without any further delay, I request the management to share with us their opening remarks, post which Q&A can follow. Over to you, sir.
Thank you, Aditya. Good morning. I am Chandramouli. Let us start the proceeding with the disclaimer class. During this call, we may make certain statements which reflect our outlook for the future or which could be construed as forward-looking statements. These statements are based on management current expectations and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. Hence, these statements must be reviewed in conjunction with the risks that the company faces. Thank you.
Good morning to all of you, and a warm welcome to our second quarter and the first half earnings call for the financial year FY26. Thank you for joining us today. Hope you all had celebrated Diwali with family and friends. Our warmest Diwali wishes to everyone, and trust the festive season bring you joy and prosperity. We will begin this call by giving an overview of company's performance as well as the first half, then open up for questions. To start with, consolidated sales in Q2 FY26 was 1,287 crores compared to 1,209 crores in Q2 FY25. This shows a 6.54% growth as compared to Q2 FY25. Abrasives grew by 7.4% from 543 crores to 584 crores. Ceramics grew by 7.8% from 280 crores to 301 crores. Electrominerals degrew marginally by 0.9% from 402 crores to 399 crores. Compared to Q1 FY26, sales in this quarter grew by 6.6% from 1,207 crores to 1,287 crores. Abrasives grew by 15% from 508 crores to 584 crores. Ceramics grew by 0.6% from 300 crores to 301 crores. Electromineral degrew by 1.6% from 405 crores to 399 crores. Consolidated sales for H1 FY26 was 2,493 crores compared to 2,393 crores in H1 FY25. This shows a growth of 4.2% growth. The growth was driven by ceramic segment, which grew by 9.4% from 549 crores to 601 crores. Electrominerals grew by 2.6% from 783 crores to 804 crores. Abrasives degrew by 0.3% from 1,095 crores to 1,091 crores. Coming to the PBIT performance, PBIT for Q2 FY26 was 111 crores against 154 crores in Q2 FY25. Compared to PBIT of rupees 81 crores in Q1 26, Q2 PBIT grew by 37%. About 51 crores, PBIT for the first half of the year was rupees 192 crores compared to 304 crores. The drop is mainly contributed by VAW, about 51 crores, RHODIUS 26 crores, and standalone rupees 34 crores. Now I go to standalone. Standalone Q2 FY26 sales was 712 crores with a growth of 1% compared to sales of rupees 705 crores in Q2 FY25. Compared to Q2 FY25, electrominerals grew marginally by 1.2% from 210 crores in Q2 25 to 213 crores in Q2 26. Ceramic was almost flat. Sales in ceramics moved from 227 crores in Q2 FY25 to 228 crores. Abrasives degrew marginally by 0.1%. Standalone sales of rupees 712 crores in Q2 FY26 compared to rupees 698 crores in Q1 FY26 grew by 2%. Abrasives grew by 7.5% from rupees 286 crores in Q1 FY26 to 308 crores in Q2 FY26. Electromineral was almost flat, with a growth of 0.2% moving from 212 crores to 212.7 crores. Ceramics degrew by 4.3% from 238 crores in Q1 26 to 228 crores in Q2 FY26. Standalone sales for H1 FY26 was 1,410 crores, with a growth of 3% compared to sales of 1,369 crores in H1 FY25. This was contributed by growth in electrominerals at 6.5%, which moved from 399 crores in H1 FY25 to 425 crores in H1 26. Ceramics grew by 4.9% from 444 crores to 466 crores. Abrasives grew by 2.8% from 611 crores to 594 crores. PBIT for Q2 FY26 was 87 crores compared to PBIT of 116 crores in Q2 FY25. Mainly ceramic contributed to rupees 17 crores. Pick up here. PBIT for Q1 FY26 was 166 crores. PBIT of Q2 FY26 dropped to 87 crores. This is mainly due to lower dividend income. PBIT for the first half of the year grew by 7.9% from 235 crores in H1 25 to 254 crores in H1 26. I go to the segment performance. Abrasives, consolidated abrasives, sales of H1 FY26 was 1,096 crores. When compared to 1,095 crores, almost remained flat. Q2 FY26 sales was 584 crores, with a growth of 7.4% compared to 544 crores in Q2 FY25. This growth was contributed by AWUKO 9 crores, Rhodius 25 crores, and QME America. Compared to Q1 FY26, sales was higher by 15%, moving from 508 crores to 584 crores. This is largely driven by sequential recovery in standalone, rupees 21 crores, recovery in Rhodius about 48 crores, which has seen a loss in Q1 on account of the transition to a new third-party logistics provider. Standalone abrasives in Q2 FY26, standalone abrasives sales of 308 crores remained flat compared to the same period last year. Sales of H1 FY25 was 594 crores with a degrowth of 2.8% compared to 611 crores in H1 FY25. Sequential growth is encouraging and looking forward to a better H2. Rhodius abrasives in H1 FY26 achieved net sales of 30.6 million euro compared to 33.8 million in H1 of FY25. This represents a 9% degrowth over last year. For the quarter, Rhodius achieved net sales of 17.4 million euro, which is 5.4% growth over Q2 FY25, which saw sales of 16.5 million. Q2 FY26 sales is higher by 31.6% compared to 13.2 million in Q1 26, reflecting the resolution of operational challenges relating to logistics. In our previous call, we had said that we expect the stability of operation to come by end of August. We almost resolved and back to normal. And we had also said that Q1 performance would impact the full year sales as well. We said that we expect the remaining 3 quarters sales would be in line with the last year's sales. In Q2, we are seeing a 5.4% growth. We still maintain the same outlook. In H1 FY26, Rhodius incurred a loss of 2.2 million euro against a loss of 0.1 million euro same period last year. This is after the PPA write-off of euro 1.4 million, reflecting the loss of sales in Q1 impacting the profitability. At the full year, FY25, Rhodius made a loss of after tax 0.2 million in FY25. We expect the loss after tax to be about 3.5 to 4 million this year. This is after PPA write-off of 2.8 million. Awuko achieved a sales of 5.5 million for the first half of the year. This is a growth of 5.3% when compared to the sales of 5.3 million last year. For the quarter, Awuko delivered sales of 2.9 million, which is a 31% growth over the last year, 2.2 million. Sequentially, it was higher by 12.7% compared to 2.6 million in Q1 26. The losses after tax in H1 versus this year remain flat. At the full year, we expect the sales growth to grow by about 20%. We maintain the same outlook. The losses before tax could decrease slightly. Now I will cover the bottom line performance of the segment. Consolidated abrasive PBIT for the first half of the year was 45 crores compared to PBIT of rupees 90 crores in H1 25. Margins have declined from 8.2% to 4.1%. The margins were impacted by Rhodius and standalone business. Consolidated abrasive PBIT for Q2 FY26 was 33 crores compared to PBIT of Q2 FY25 at 34 crores. Compared to Q1 FY26, the PBIT was higher by 22 crores. This is sequentially driven, compared to PBIT of the same period last year, Q1 FY26 was 11 crores. This is mainly due to Rhodius and standalone abrasives. Electro Minerals consolidated sales for H1 FY26 was 804 crores compared to sales of 783 crores in H1 FY25. Standalone business and Foskor Zirconia helped to grow this. Standalone business grew by 26%, Foskor grew by 20 crores, and Wadi grew by about 83 crores. Q2 sales was 399 crores compared to sales of 402 crores in Q2 FY25. The growth was on account of VAW. The degrowth was on account of the VAW. Sales in Q2 FY26 was rupees 399 crores compared to rupees 405 crores in Q1 FY26. This is also largely arising from VAW. Standalone Electro Minerals. Standalone Q2 sales was 213 crores. This is a 1.2% growth compared to sales of 210 crores in Q2 FY25. The growth was largely aided by volume while prices remain flat. Exports continue to perform well in this segment. Compared to Q1 FY26, the sales in this quarter was almost flat. Sales for H1 FY25 was at rupees 425 crores with a growth of 6.5% compared to rupees 399 crores in H1 FY25. This growth was aided by volume and price. Export definitely helped a lot. VAW sales in local currency in Q2 FY26 degrew by 37.2% compared to Q2 FY25 from ruble 2.4 billion to 1.5 billion ruble. In INR sales, the degrowth was 27%. The exchange rate used in Q2 FY25 was 0.94 compared to the exchange rate used in Q2 FY26 is about 1.08. Sales in local currency degrew by 15%, that is 1.8 billion ruble to 1.5 billion compared to Q1 FY26. WA delivered a profit after tax of ruble 222 million in Q2 FY26 against 466 million during the same period last year and ruble 71 million in Q1 26. In local currency H1 FY26, the sales was 3.3 billion compared to 4.9 billion in H1 FY25. This is a decline of 31%. We communicated this expectation earlier. In INR terms, the sales decline was from 459 crores to 364 crores, resulting in a decline of 21%. H1 FY25 profits were ruble 294 million compared to 753 million ruble during the same period last year. This is a decline of 61% in terms of H1 profit. From 70 crores, it declined to 31 crores. With respect to the full year performance at VAW, we had earlier communicated a drop in volume by about 25%. We maintained the same guidance now. Fusca Zirconia for the quarter, sales was Rand 114 million compared to sales Rand of 82 million in Q2 25. The loss after tax was Rand 24 million compared to loss after tax of 21 million in Q2 FY25.
Sorry to interrupt you, sir. So there is a lot of disturbance coming from the background from your end.
We don't have any sound coming from our end. Nothing is there. No one talks. Nothing is coming.
Okay, I will just check. Got it. Because there is a lot of vehicles and things coming out from back end. No problem. I'll just look into it. Sorry. You can please continue.
All right. In Q1 FY26, sales was Rand 121 million, and in Q2 FY26, the sales was Rand 114 million. In Q1 26, the loss after tax was 18 million Rand compared to the loss after tax in Q2 26 of Rand 24 million. In H1 26, sales was Rand 235 million compared to H1 25 sales of Rand 203 million. In H1 26, loss after tax was Rand 42 million compared to 32 million in H1 25. I move to ceramic business. Consolidated sales for H1 FY26 was 601 crores compared to 549 crores in H1 25. This is a growth of 9.4%. Growth was driven by standalone operations and the Australian subsidiary. Q2 FY26, the sales was 301 crores compared to 280 crores in Q2 FY25. This is a growth of 7.8% and was driven largely by our Australian subsidiary. Standalone ceramic Q2 sales was 228 crores, which is flat compared to Q2 FY25. Compared to Q1 26, sales in this quarter degrew by 4.3%, basically 238 crores to 228 crores. Sales for H1 was 466 crores. This is higher by 4.9% to 444 crores in the same period last year. To cover the PBIT of the segment, consolidated PBIT for Q2 FY26 was at 62 crores compared to the PBIT of 75 crores in Q1 FY26, mainly due to product mix and volume. Consolidated PBIT of H1 FY26 was 137 crores compared to 144 crores in H1 FY25. Standalone ceramics PBIT decreased by 3.8% to 107 crores from 111 crores in H1FY25. There was no debt in our standalone books. Total debt at consolidated basis was 210 crores at the end of Q2FY26 compared to 170 crores at the end of Q126 and 103 crores at the same period last year. The debt-to-equity ratio is 0.06 at consolidated level. Cash and cash equivalent at the consolidated without cash in VAW is about 215 crores, which means debt net of cash is zero. During the H1 FY26, our capex investment was 162 crores against 124 crores in H1 FY25. This is against our full year plan of 350 crores as we communicated during the last call. So we are progressing as per that plan. At the standalone level, the capex was 120 crores compared to 16 crores same period last year. Now I'll provide an update on the outlook for the current year. I maintained the outlook shared last time, which is as follows. Consolidated sales growth could be 5.5% to 6.5%. Consolidated ceramics growth could be 16% to 18%, same as earlier communicated. EMD growth guidance is about 1% to 2%, same as last time communicated. Abrasive sales in our last call, we communicated 4% to 5% growth for the year. Margins at consolidated level, ceramic section, we communicated 23.5 to 23.7 on a full year basis. Maintained the same. EMD in the last call, we said 4.5 to 5.5%. Abrasives last time we said PBIT margin could be 6% to 6.5% on a full year basis. We said that last time the overall PBIT margin could be 8.2 to 8.5%. We maintain the same. Capex side, we would spend about 350 crores. We have spent about 162 in H1. So we think we will meet the Capex plan. So that's broadly my opening remark, and I think I'll open up for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Thanks for taking my question. My first question is with respect to the standalone segments of abrasive and ceramics and refractories. The growth were subdued during this quarter. So if you can give a bit more granularity in terms of quality of growth in abrasives in the retail side and the industrial supply side. Similarly, for ceramics and refractories between the wear ceramics, metallized cylinder and refractories, how the individual subcategories were growing, that would be great, sir.
So thank you. I think so the growth in the standalone segment, particularly electromineral, was about 6.5%, ceramic 4.9%, and abrasives degrew at 2.8%. But the growth sequentially in abrasive at 7.5% is encouraging. We expect that trend to continue for the second half. And that's the broad outlook that we have. And as far as the ceramic is concerned, the H2 will be strong, largely because of the way the order books were built and some of the projects, requirement are coming along. So we expect that there could be a H2 will be heavily loaded compared to the H1. So hence we feel that the growth compared to the H1 versus H2 will be different. And electro minerals will continue the trajectory that we have been committing. That should continue. That's what broadly gating to.
And within the subcategories, any flavor, sir? So, for example, ceramics and refractories, how wear had performed, how refractories had performed, how metallized cylinders had performed.
Yeah, so metallized cylinders and engineered ceramics have performed over 20%, and I think the wear challenge is basically on the wear ceramic side. Both wear and some of the refractory side, the project-based dependence. There is a delay which would pick up in the next quarter, and we should see a overall growth. At a H1 level, we are at about 11% growth. We expect that would pick up.
Okay, and which sectors would these wear ceramics would be catering to where there is delay? Is it like steel, cement?
So it is steel, cement, glass, all these sectors. There are some project delays.
Understood. And similar flavor on abrasive side, retail, vis-a-vis industrial supply, how it is doing? Any flavor on that?
So I think industrial and precision are doing fine. Retail is a bit subdued, but the encouraging thing is that the inventories at the dealer level have really come down, which sees that Q3 and Q4 we should see a pickup. The lot of festival pickup helped to move their inventory level, so that is something is encouraging to look at Q3 and Q4.
Got it, sir. And my final question with respect to the electromineral business, you had highlighted that there is a bit of Chinese competition in aluminum oxide and how it is panning out. So is there increased competition which is there, or is it maintaining? Any views on that?
It is maintaining, and no difference that we see at this point.
Got it, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, thank you very much for the opportunity, sir. So my first question is on standalone ceramics. I think the margins over there have been the weakest we have seen in last 4 years, about 20% or so. You have highlighted adverse product mix as one of the reasons. What could be the other factors over here? Also, we had expected a strong revenue growth as clean energy sales to the US-based customers are reviving. However, we have posted only flattish sales. So if you could explain correlate these things, that will be very helpful.
So I think product mix, and the other one is top line. There's base level fixed cost absorption needs to happen. So since there's a top line is a bit soft, so that's why we expect the H2 we could pick up. I mean, we will bounce back better in the H2, and that should start showing the margin pickup. And that's why even in the overall margin guidance, I still maintain what was earlier said.
Right. Just a follow-up to that, sir. When our metallized cylinders and engineered ceramics are doing so well, which are obviously the higher margin businesses for us, vis-a-vis the wear ceramics and refractories, shouldn't the product mix be good for us? Should that not be an accretive product mix?
It does, and that is why it is helping us a bit. But if you look at that, the wear plus the fired refractories business, they are not bad. Their margins are also very encouraging margins. But the volumes that they hold to the total business, when it is not growing, it does have the impact of the mix, and that's why I use the word mix.
Understood. So my second question is on the subsidiary level electro minerals business. Here the sales seem to be very strong despite the continued sanctions on VAW. Margins have also improved on sequential basis. So how have we achieved this improvement in the past?
No, so I think if I look at it, abrasives, we have done fairly well. Outside, of course, there's a domestic abrasive pickup, equally Foskor zirconia top line pickup. These two are helping us in terms of our overall pickup. But you have also a fall of almost 83 crores in the top line as far as VAW is concerned. But the eliminations, the intercompany eliminations are lower compared to the last year because we no more source from VAW. So that benefit also accrues to us. So that is how the overall we are in better shape as far as electromineral is concerned.
And sir, just lastly, a bookkeeping question on our other segment, wherein we combine the results of Plus, Sadco, as well as the IT business. Here we have posted the positive PBIT after consecutive losses of 14 quarters. Anything you could highlight here?
I think I don't want to track individually these smaller businesses, but I think all of them are doing fine. So all of them are fired well, and that is the basic reason for that.
Understood. Thank you very much, sir, for answering my questions. I'll come back with you.
Thank you.
Thank you. The next question is on the line of Amit Anwani from PL Capital. Please go ahead.
Thank you, sir. Thanks for taking my question. First question on VAW again. So obviously you have highlighted that there would be 25% reduction in volumes. Wanted to understand any development which has happened on sanctions, and in case of sanction continuing, what kind of volumes are we expecting? Any strategy or any hope of sanction getting lifted? How should one think of this business slightly medium term? Yeah.
No, look, I think this is a very tough area to guess because this is a geopolitical question. I would like to stay away from that. I think you are as good as mine or more than mine in terms of knowing the geopolitical situation as everyone reads instantaneously as everyone tweets. I feel that our focus at this point in time is to stay within the ambit of what we can do, and that I think is what we will stay. What is helping us is a debt-free company and also highly focused way of running the business helps us to stay afloat. And we hope, sooner some better prospects would come.
Sure. Sir, on the two subsidiaries, Awuko and Rhodius, would love to understand, are we on track for break-even, and when are they happening? And second, with respect to what is driving the demand, I understand there's a lot of slow sales. There is global in nature. So just wanted to understand what is the situation on demand side for this subsidiary. There's some improvement which has happened, and we are expecting H2 to be slightly better. So updates on that.
Sure. So I think the Rhodius drop in Q1 is a one-off event, largely driven by the way the logistics was handled, but they are out of that and they are back to normal. And the demand, I would say, it is good, and it is continuing the way we are planning as far as Rhodius is concerned. And we, as I said, that we continue to look at Rhodius as a good company would get back to the profitability even after PPA soon. That is what we are broadly looking at. As far as Awuko is concerned, we feel that getting to roughly about 12 to 14 million euros top line for this year is the first milestone that we should hit. So far, it looks like the trajectory is towards that. And then at the end of the year, we will again update you in terms of how we are looking beyond that. So by and large, both are traveling as per what we are looking at.
Sure. So lastly, sir, on the new product developments, last time I recollect you highlighted the high performance SiC pilot plant is on track. Though we do not expect volumes in F26, F27. So any update on that? And apart from that, I think a lot of activities happening on semiconductor. CG Semi installed the plant, and even L&T is talking about it. So, and we also talked about some ceramic-based products for semiconductors. So just wanted to understand, with respect to product developments, what one should look at in near to medium term, which can materialize in 2-3 years.
Sure. So semiconductor, basically ceramics for semiconductor fab equipments is what our focus area, and that facility is coming up very much in line, and we expect these would start benefiting in the next year onwards, which is what our earlier cadence also. So that would continue. And the defense program, aerospace and defense program investment is also very much on track. The investment on HPSIC is also very much on track. All the programs that we broadly talked about as far as our long-term strategy is concerned, everything is pretty much on track. That's why you see a strong, capex spend, which is very much in line with our spend as well. In fact, the 160 odd crores is probably the highest at this point in time. So we are progressing based on our long-term trajectory.
So are we seeing any contribution coming in from these projects in next 2 years, or it will be beyond years?
So as far as the semiconductor, we expect that it would start contributing from next year. And then aerospace and defense partly next year, but mostly year after. And then as far as the HPSIC, we said 2 years we need to wait because these are all seeding time, which is what we are currently doing.
Yeah. Thank you so much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Rupesh Otwani from Nayan M. Vala Securities Private Limited. Please go ahead.
Hi, sir. Am I audible?
Yes, you are audible. Thanks, Ritesh.
Hi, sir. Thank you for taking my call. I just would like to know that, over the past 2-3 quarters, if I am to look at your other expenses, they are on a standalone basis. They have grown, they've grown on a higher trajectory, which has been affecting your overall margins. So if you could maybe just shed some light on what is causing that increase, that would be really helpful.
I think other expenses, what you call as unallocable at the console level, is very much comparable at H1 to H1 level. And standalone level, there is a marginal increase about 10 crores. So I see that it is very much in line. We don't see abnormality, except there are some dividend income movement, which is like we also disclose that close to some 68 crores plus is a dividend that we had, kind of one-off dividend, which other than that, I think if you exclude that, as we exclude and see, we see that it is very much in line.
Okay, sir. And I just wanted to confirm that you had said that in this call you had said that VAW is not, exporting raw materials to the Indian subsidiary for, let's say, from the electrominerals perspective. So, would that affect our margins anyway in the abrasives or any other segment?
I don't think we had any link to our domestic abrasive business. We never sourced for our domestic abrasive business and has no connection to that. And we are not sourcing. That stopped, yeah.
All right. Thank you so much. I'll join back.
Thank you.
Thank you. The next question is from the line of Bhavin Vithlani from SBI Mutual Funds. Please go ahead.
Yeah. Good morning, sir.
Good morning, Bhavin.
Sir, the question number one is with respect to your comment to the earlier where I also was observing a 35% increase in capital expenditure. If you could help us, what is the planned outlay for the current financial year and the next? And if you could also give us breakup between the key projects that we are planning this capital expenditure.
Yeah. So, Bhavin, I think we did guide 350 crores of capex at the full year level is what our guidance is. And we have spent about 160 odd crores now. The second half, we will have the rest. And this is as per the long-term strategy program that what we have worked on. So it is very much in line. Individual project details will be difficult to share, but these are coming for, let's say, semiconductor facilities, facilities for aerospace and defense, investment in HPSIC facility, investment in tin wheel relocation. All that these are the programs that we are working on.
Sure. So pardon me for harping this. What would be the total planned outlay for the semiconductor, for the aerospace defense ceramics and HPSIC over a 2 to 3 year basis? The total planned outlay for getting the project up and running in the phase one of our plan.
So, Bhavin, I think it is a reasonable facility, and based on our expected returns and the top line is the normal way that we evaluate and put. Individually, we are unable to share, how much is this, etc. But be rest assured that it is based on anchor customers, programs that we have in place to support that, and that is how we are making these investments.
Sure. My other question is on the electrominerals, and when I look at the subsidiaries performance, which is standalone minus the consolidated, the revenue run rate that I see for the quarter is about 186 crores, and prior to the sanction, it used to be about 190 to 200 crores. So it's not very different despite the sanctions. And this is a continuous process. The VAW is a continuous process business. So could you help us understand, is the impact that we are seeing is largely the realization where we've been able to push out the volumes, maybe at a lower margins? And in this quarter also, we've seen a remarkable improvement on the profitability front. If I look at the EBIT of the division where it was negative in the previous quarters, about 2-3 crores, and it is about 13 crore positive. So the effort that we are putting, it will be helpful to understand and what transpired such a improvement despite the sanctions.
So, first of all, sanction does affect. It is not that it is not affected. As I told that at H1 level, we have an 83 crores of impact on the electromineral business. So it does affect. But what helps us is the standalone growth in Foskor is helping us to a large extent to offset this. So that is what I would say rather than anything else. And obviously that helps us also to some extent a margin stabilization. And I think had VAW performed at its normal level, we would have enjoyed a far more better results than this. Hope to see that day soon.
Sure. And if you could, if possible, what would be the plan, assuming these sanctions go on for years? What is the plan of action for the company to get to alternative markets, alternative customers?
See, I think I'm sure this is very difficult to even walk through a simulated experience of answering this question because it's very tough. From our side, we have an approach where focus highly on what VAW can do with the limitations what they have. So that's number one. Make sure that we run this in a way which is within the framework of what is possible, highly focused on cash conservation, making sure that they have reasonable, margins and able to survive. At the same time, thinking beyond, how can we do beyond this is a very, very difficult task, Bhavin. We have limitations of what we can do. So definitely, and as a group, we will not do what is not possible.
Sure. So my last question is on the abrasives front. As we've highlighted, there are three broad segments: retail, industrial, and precision. Retail is where the pressure was, but I also understand is that within the precision and the industrial, automotive as a sector has a greater salience. And as we are seeing pickup in the automotive production, if you could just give us an outlook in terms of, do we see rate of growth for the standalone abrasive improving? Because yesterday our competitor also reported, and they reported kind of a 6% growth. So your outlook over the next 3-4 quarters, given the automotive pickup, and how do you seeing will be helpful?
I think, as I said, that our own reading is that the H2 for the abrasive is going to be better. First of all, if you look at Q2 versus Q1, we are seeing a pickup in terms of growth, and we have grown about 7.5% plus, and we expect Q3 and Q4 will be better on few things. One, our own retail network, the kind of inventories with them is kind of far more thinner at this point in time because of what they had experienced in the last quarter. So the benefit of GST plus the festival growth, etc., we should see this coming up in Q3 and Q4. So I would say that our expectation for us is definitely better in H2.
Sure. Yeah. Thank you so much for taking my question.
Right. Thank you.
Thank you. The next question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I joined the call a little late, so pardon me if my question is repetitive. So my question is largely on recent developments at Wendt. So post exit of 3M, we are primarily the de facto promoters in the company, and in the past we have seen transfer of talent, from Wendt to CUMI as well, and recently we have seen exit of top leadership as well from Wendt. So question is, what is our play here now with the entity, and what is our aspiration and expectations from that company, and what will help us achieve those?
So, thanks for this question. I would stick to commentary on the performance of CUMI here, and I'm sure you appreciate constraints on that. We should talk about CUMI, and I encourage you to focus on CUMI.
Understood, sir. And sir, second is more of a feedback. The group is known for being investor friendly, stakeholder friendly, and our benchmark when it comes to investor communication and practices. But sorry to say, we are disappointed with the approach here at Wendt. We as long-term investors even participated in AGM, registered as speakers, put our queries, but it's been more than 3 months to say there has been no reply. Worse, the subsidiary has been reporting poor numbers, and we have no idea what's happening in that business. So this is very unlike Murugupa Group company. So how do we rectify this? Because as long-term investors, we are still waiting for the opportunity to get our queries addressed.
Sure. Thanks for expressing your sentiment. I would take this back and probably convey this to the Wendt team, and they would get back to you.
Perfect. Thank you.
Thank you.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Thank you for the opportunity. I just wanted to check with you, sir. So standalone business started to kind of grow over the last 3-4 years, mid to high single digit, more towards mid than high. I'm talking overall business. Would you give us a sense of what needs to change to accelerate growth to higher levels? That's the first question. Linked up to that is, of the 350 crores that you are spending in, is the split a lot more towards existing businesses, or is it a lot more towards new lines of work?
So I think, sorry, your second question is not audible. Could you be clear on that?
Sure. What I was asking was that in that 350 crores of capex, is it more inclined towards existing lines of work, or is there a fairly meaningful share of new lines of work?
Okay, good. So I think what needs to happen to have a higher growth is the first question as far as standalone business is concerned. So I think this is the program that we have for a 5-year horizon. From now till FY30 is where the LTS the work that we have prepared ourselves. I think each of this business have come up with a set of actions which would take the growth from the current level to a higher growth rate. We feel that each of them are definitely working towards that. I think we broadly shared last time around that. I think the abrasives is largely going to focus on sharpening the go-to-market, introducing newer products through the NPE program. Similarly, we also have a program of how do we source and scale, and these are the programs. And of course, there are specific geographies today we are not present or have our market share is lower. So how do I make use of those? So these are the opportunities that we should see and pursue this. In the electro minerals, we said that scaling up in alumina, move more towards the treated grinds, either it is C-treated or silane treated or sol-gel treated, blue treated, zirconia treated grinds, thereby increasing our alumina portfolio. At the same time, focus on the value-added products through additions of zirconia, zirmol, stabilized zirconia, etc., and getting into new areas like thermal spray powders, etc. These are the programs as far as electromineral is concerned. As far as industrial ceramic is concerned, our focus is largely in terms of how do we serve in newer areas like semiconductor, electronics, aerospace, and defense, and how do we prepare ourselves for that, which is what is the program that each of them are working. And in terms of the refractory, it is mostly to scale up on the monolithic refractories. Just broadly summarizing it, so these are the programs which will help us to accelerate the growth. What you have observed as there is a pickup, but will it pick up further? So the answer is yes, and these are the programs that we would work on. Of the 350 crores, are you investing in new areas, and if so, how much? I would say a majority of this investment goes into newer areas, is what I would, share with you.
Understood, sir. I think those are two questions from my side. Thank you so much for your response. Thank you.
Good, thank you.
Thank you. The next question is from the line of Mohit Pandey from Citi. Please go ahead.
Yeah, good morning, sir, and thank you for the opportunity. So first question is on metallized cylinders. So I believe you mentioned in this quarter there has been 20% growth. So just wanted to understand if what are the capacity utilizations there now, and are there any expansion plans here? The end market does look like growing quite smartly here. Yeah, that would be question number one.
Yes, I think you are right. I think the end market is going very strong, and I shared over 20% growth, which is what we are telling, and we are also parallelly looking at how do we prepare ourselves for an accelerated growth, and so clearly we have a program to address that.
All right, sir. So secondly, on the aerospace and defense ceramics, is it possible to share